Equity, bonds and trading. Overview. Security is an instrument where we invest money with the expectation that we'll get back that money along with some return. Based on the nature of the return, there are two kinds of securities. One is fixed income and second is variable. In fixed income securities, there will be a constant return like interest over a period of time. In case of variable income, we cannot predict the income before. Example, stocks and shares. Shares means a ownership in a company. When we have a shares, it means that we are the owners in the company. So when company performs well at the end of the year, they will pay the dividend. So this is the return on the shares. Bonds are a good example for the fixed income securities. They pay predefined interest rates over a period of a bond. There are two kinds of interest bonds will fetch. One is fixed rate, another is float rate. Fixed rate means interest rate is constant over a life of the bond, whereas float rate, so bond interest also will get changed based on the market fluctuations. Whenever market is changed, accordingly interest rate also will change. Debenture is also like a bond. It is like a loan, but here issuing authorities are corporates. I will explain some key words related to the trading. First, primary market. Primary market means the market where first time we buy the securities, means shares directly from the company. This is first hand purchase. Next, once the shares are purchased from the primary market, then we need to sell or buy in the secondary market. Secondary market is like second hand. Initial public offering. So when company issue first time shares, they will come with an offer with a prospects to the public, and then public will invest the money. Stock exchange. This is the place. This is related to the mainly from the secondary market where sale and purchase of securities happens. Next, demat. So demat account is used to keep the shares in electronic form instead of physical form. This is the flow of trading. Let us say investor want to buy a shares, then he will place the order with a broker, then broker will buy the shares on behalf of the investor. Then in same way seller will be there. Seller want to sell his shares, so broker take the shares and sell the shares in the clearing house. So here seller give the shares and it will come to the broker and come to the clearing stock, then broker, and then it will come to the investor. Same way buying investor will pay the cash through broker and it will come to the seller. Limit order. Limit order means, let us say if you have a predefined amount for which you have to sell or buy a share, then you can predefine that amount, then you can key that amount. Whenever market rate touches that amount, automatically order will be executed. Market order. Market order means order will be executed based on the prevailing current market rate. Contract note. This is the binding document between the broker and the investor where details about the purchases and sales, rates, date, time, everything will be specified. Stop loss. This is also like limit order, but the purpose here is to stop the loss. So investor can define a price at which order has to execute.